Coming up today, a big week ahead for the markets. Will J Powell go back to hawkish on Wednesday? Will the Treasury release more liquidity? Oil pulls back, Japan steps in to save the yen, and Elon Musk brings home the bacon from his trip to China. Welcome back everybody to the start of a busy week across financial markets. Just like to give a quick shout out and welcome to all my new subscribers to this channel. We had a record amount of views last week, so thanks to everybody who tunes in every day, and let's get stuck into it. Just as we've been saying last week, S&P 500 climbed up into this resistance zone I've had here, above 5100. If the market was going to stall out, I'd be expecting it to stall out in this zone, going up to 5150. And we are getting a bit of a continued bounce in risk on assets. Now got the S&P, Nasdaq, Dow and Russell above the 20-day moving average, and we can see the wave flow starting to coil up here and potentially go green. Also helping the bulls is volatility, yields, oil, the dollar and inflation expectations. Turning red back up the front, and that has been led by growth stocks. One of the best performing sectors today, consumer discretionary. Gave you guys that long swing trade idea last Monday after we were getting some reversal signals and quite a bit oversold. We're playing that back to the 50-day VWAP, which we got this morning on a nice opening gap up there. And there's the market getting a bit more relaxed with the VIX closing below 15 today and volatility risk premium coming off as well. The big event this week will be the Fed meeting on Wednesday, and it's pretty much a given that they're going to keep rates on hold. Markets priced that in with near certainty. What we'll be really looking for is whether J Powell's changed his tune from that of being dovish to being hawkish, which would be justified given the hotter than expected inflation print we've been seeing since the last time the Fed met. With some saying he's likely to scramble back to a hawkish stance, with inflation looking real sticky, some key commodity prices moving up sharply. However, what makes this a little different is we're heading in to what's going to be one of the most hotly contested US presidential elections many of us have seen in our lifetimes, and the Federal Reserve plays a role in that. They can help to loosen financial conditions by lowering interest rates, lowering their quantitative tightening program, and in partnership with the Treasury, help to pump more liquidity back in the system and bring down bond yields, which has a material effect on markets and the economy and can help to sway the election results. And we just heard today from the Treasury, they actually have to borrow a little bit more as tax receipts are falling short, which is not a good sign in what's supposed to be a booming economy with record low unemployment. The department said it expects to borrow $243 billion during the April to June quarter. That's $41 billion higher than the estimate announced at the start of this year. And so that would be supportive of higher bond yields. However, the key event will be on Wednesday, just before the Fed meets. The Treasury is going to release details of potentially their first buyback program in more than 20 years, in which they're going to use their excess liquidity in the general account to potentially buy back some short-dated bonds and issue less. In other words, reducing the supply of those bonds, which should help to bring down bond yields. Because like I said last week, the government first came after oil, which appears to be working, and now I think they're coming after bond yields. As they've been ripping high these last couple of months and approaching 5% again, I'm pretty certain they do not want to see yields hold above 5% going into the election. And that's why I think they actually fell today again, even though the Treasury said they have to issue more debt this quarter based on tax receipts. It'll be what we hear out on Wednesday that could really get markets moving. And there's a look at the 2-year, which only had a slight pullback today. It was more in the longer durations of the 10-year, just sitting here at 460, which like I said is a bit supportive of long duration Treasury funds. And what we hear on Wednesday, especially from J Powell as well, if he doesn't come out too hawkish and wants to somehow keep towing the dovish line, then that could add to a further rip in TLT. And just looking at high yield bonds, they're trading really well. Credit spreads still near record lows. Bond market's really not pricing in anything bad for the economy anytime soon here, apart from higher inflation for longer, as we can see in the spread of inflation protected treasuries versus regular treasuries. And so if yields stay elevated, that should prove to be a headwind for the stock market, especially since last time we saw the 2-year get up to 5%. That did cause a bit of weakness and a multi-month pullback in the S&P. And then the Treasury and the Fed both came out, worked their magic, managed to talk yields down, and that lit a spark underneath the stock market. However, Jay's likely to come out and walk the line and probably say something like, we need to wait and see for more confirmation of inflation coming down before we can cut rates, and maybe just say these recent hot prints may be temporary, but we won't know for sure. However, if he were to give any hint of the possibility of a rate hike that could cause the stock market to have a very sharp pullback, as right now he hasn't given any indication to the possibility of hiking rates this year. Also going to play a big influence this week is getting into the thick of Q1 earnings season, which so far has come in a little better than expected. As we approach the halfway mark for how many companies have reported, about 77% of them have reported above expectations, which is a little bit better than long-term averages. On Thursday, we'll hear from the second biggest stock in the market, Apple, and they've been under a bit of pressure lately. Low growth, struggling to make inroads in the AI arena, and they just recently launched their new Apple Vision Pro headset, which will get a first look at how their initial orders have gone. It's an expensive product for $3,500. Some people have said it's caused neck pains, headaches, eye strain. It's still version 1 and it's yet to be proven whether that's really going to be a profitable product for Apple shareholders. They've also had some soft sales out of China, with sales volumes falling 19% during the first quarter, and we'll be looking to hear more about the upcoming iPhone 16 launch. And with some saying the AI bubble's already popped, got some other research coming out today from Capital Economics forecasting the bubble won't crash till 2026 and should take the S&P 500 to 6,500 by next year before unwinding the following year in 26. And they modeled that on the previous dot-com bubble of the late 90s and looking at data in the roaring 1920s as well. Potentially helping the picture this week is cooling tensions in the Middle East. Ever since Israel struck back at Iran, things seem to have dialed down pretty quickly. And now we're getting reports that Israel and Hamas could start engaging in ceasefire talks this week, as the Biden administration has been pushing for that hard for a little while now to try and get things to cool down over there, along with the price of oil. And there's a look at crude today, losing its 50-day, closing at $82.60 a barrel. And similar picture, still holding up a bit higher there is gold. It was actually platinum having a good day, up 4%, along with a bit of a bounce back in natty gas, and uranium starting to tick higher again as well, with a huge unwind in the cocoa trade, losing its 50-day for the first time since the start of this year. Looks like it hit a few trailing stops in trend following funds there today, but we've still got a strong uptrend in coffee. And got another bump up in Chinese securities today. Just going out to a weekly chart. Chinese stock market is up 11.3% year to date, which, believe it or not, is actually the best performing international stock market so far this year, as we come up to the half year mark, well ahead of the S&P 500, up about 7.5% year to date. And to zoom out, looks like we're closing above this big downward trend line we've had for 3 years now. And for those of you who missed it, I did a deep dive into a stock I recently invested in that has exposure to the Chinese market, and that's Up Fintech Holding, otherwise known as Tiger Brokers, under the ticker TIGR. And if you missed that one, I'll put the link below this video if you're interested in watching it. And so I've got a few questions about this one. First off, let me just make it clear. I didn't accept any payment from this company to make a video about it, and I've never accepted any payment from any company to promote them. I never have, I never will, as I consider that's unethical, and I'll never engage in pump and dump schemes. I just simply shared my own research from a stock I like and that I'm invested in. And to be clear, it's not a Chinese company. They're actually a Singaporean company, headquartered in Singapore, where most of their customers are. They also have offices all around Asia Pacific and in America, where they also have customers. They're fully registered and licensed. They're partnered with the largest online broker in the world, Interactive Brokers. And also got a few questions about what would happen when China invades Taiwan, which is a really good question and something I've talked about before. And so whilst that would potentially have a negative effect on this stock, as it would many others, in fact, the whole global stock market may sell off when that happens. Could take a dive for a month or so, just like back in early 2022 when Russia invaded Ukraine. However, Tiger's already been barred from China from offering their services to Chinese mainland residents. However, they do allow everybody else outside of mainland China, including Hong Kong, Australia, Kiwis, Americans, Singaporeans, to directly invest in Chinese mainland stocks. And so you could think of this broker as kind of the Robin Hood of Asia Pacific. And so whilst they may sell off when China invades Taiwan, it shouldn't have any direct impact on their actual operations or customer accounts, for which they have over 2 million now. And considering the world's biggest online broker, Interactive Brokers, is valued at almost $50 billion. In my opinion, it's not unreasonable to think Tiger Brokers, which could very well be one of the biggest online brokers in the world in a couple of years, especially in the Asia Pacific region, it's not unreasonable to think that they could potentially have a 10, 20, who knows, maybe even in the long term, a $30 billion market cap, as they're exposed to these really high growing markets in Asia and the growth in the number of online traders in Asia. Big gaming culture, and a lot of them are getting into the stock market, especially with US stocks looking to go 24-hour trading, as Tiger allows customers in Asia Pacific to access US stocks as well in a two-way bridge. So with a market cap of $500 million, That's why I like it. I think the risk reward is skewed to the upside. And like most of my investments, I'm looking to stay in this for at least a year or two, or however long it takes for it to hit my stock fair value, which hopefully climbs in that time as well as the business and outlook improves. And so in my own trading and investing, I typically invest in small caps and swing trade large caps. However, that's not the case with Alibaba. It's one of the very few large caps I'm invested in, as I believe that too is significantly undervalued. My stock fair value has it currently at $116. About 34% below, and again, hopefully that increases as we move back towards fair value. However, this stock definitely has more risk. When China invades Taiwan, it's probably going to get sold off really hard. However, at that point in time across markets, it may present a buy the dip opportunity actually, and that invasion still may be a number of years away. No one really knows exactly when it's going to happen. But for here and now, the Chinese market is breaking out and leading international stock markets this year, and I think that's what authorities over there would like to see as well. And staying in the Asia Pacific region, moving on to China's long-standing foe of Japan, with the market finally forcing their hand and getting them to step in and save their yen, which had been diving and going down the toilet for a little while here, as rising US yields and the US dollar, along with the yen, along with the BOJ having to pull back from their hawkish stance, caused a bit of a run on the yen, with speculators and traders piling on. It's been reported that they stepped into the market and have tried and halt the decline by doing a little trading themselves. And there's a look at the dollar yen today, printing a huge spinning doji candle on volume, typically what you see on tops and bottoms, and what I'd otherwise call a signal candle. And we may retrace pull back, given a potential entry candle, and we very well could retrace back to the 50-day here. That's just a crazy move to have a high and low range of 5.5 points on the dollar yen, something you won't see too often. And there's a look at the dollar index, pretty much consolidating as well, along with Bitcoin coiling up. Low volume, low volatility. And just moving on to Tesla, over the weekend, Elon Musk made a surprise trip to China in an effort to roll out the self-driving technology, FSD. He met with senior Chinese officials, including Premier Li Qiang, and it appears to have paid off in spades, sending the stock up over 12% today, adding to last week's gap up after they reported earnings. And Wedbush's Dan Ives said it looks like a home run for the EV maker, partnering with Chinese company Baidu for technology associated with autonomous driving, and passed a key data security and privacy requirement, with China's government officially signaling to Musk that it would support Tesla's FSD rollout. And that is really good news for Tesla bulls in the really important market of China, and them looking to actually embrace the company and its FSD technology, because if they can prove it there, they'll be able to sell it and license all around the world to other EV makers like they did with their recharging network. And more importantly, just improves the sentiment and outlook for the stock. After it had been weak for some time, but put in its best day today in a long time, actually finishing up over 15% on huge volume. Big thick volume candle here, and it's actually quite surprising to see. After last week's worse than expected earnings, market gapped up, and after this surprise visit of Musk to China, just shows the power of Tesla and why you can never rule it out, and it's so hard to short, because out of nowhere it can often just go on a run. And so here we are, just below $200 a share. After a week ago, we were down in the 130s. Still a very highly volatile stock, even though its market cap is back above 600 billion now. Staying on mega cap tech, there's NVIDIA sitting right at the 50-day. To look at Apple going into earnings on Thursday. Microsoft still a little soft after their earnings last week. We'll also get to hear from Amazon tomorrow. Bit of a pullback in Alphabet after their great earnings announcement on Friday, and Meta as well having a little bit of a pullback after their big gap down earnings on Thursday. Even though they came out with really good numbers, market actually sold them off. Over to economic data, always a slow start to the week. Into tomorrow, we get a bit of GDP data and inflation prints from the Eurozone, a little bit of housing data from the States. Going into Wednesday, we'll get a look at the jobs market with the ADP employment change, some manufacturing PMIs, JOLTS job openings, and of course the big one, the Fed interest rate decision, along with the Treasury announcing details of what they're going to do with their excess liquidity. Going into Thursday, we'll get some more jobs data, and then finally finishing out Friday with the big jobs report, non-farm payrolls, and unemployment rate expected to come in at 3.8%. Fed Fund futures still just pricing in one rate cut this year, and the fear and greed index almost moving back into the neutral zone, and a bit more improving breadth. Now about half of all stocks above the 50-day average, and getting positive again on net new highs versus new lows. Like I said, this bounce is extending itself, led by growth. Another good bounce up for clean energy shares. Another move up on one of my favorites, A-Mark Precious Metals. And there's a look at JP Morgan, just consolidating above the 50-day VWAP. Alright guys, there we have it to start off this busy week in markets. So we may coil up again tomorrow, going into the big Wednesday announcement from the Fed and Treasury, which we may get a big move either way out of that. Jay Powell was to come out hawkish and even started hinting at rate hikes. I don't think he would, but if he does, market could lose a quick 100 points. If he actually keeps talking dovish and talks about cutting quantitative tightening, the amount they reduced their balance sheet in half, along with loosening financial conditions from the Treasury and releasing more liquidity back in the system, trying to get bond yields down, we could quickly add 100 points on the S&P 500. So we may be calling up going into that. And like I said, the market is making some risk-on moves. Just looking at market color here, got volatility really pulling back, along with the 10-year and oil and the dollar. That's all supportive of stocks. And so for now, we just kind of sit in a bit of a middle zone, waiting for the big day of Wednesday. Then, of course, another big day on Friday with jobs data, unemployment report, along with key earnings, including Amazon tomorrow, Apple Thursday. Thanks very much for sticking with Click Capital and hitting that like button, and I hope to see you again tomorrow night. Cheers.